22 trillion in 2022, so it's like an increase of $7 trillion in 2 years, and the money supply just went through the moon, and that's what's causing the inflation in the United States. What is it? See, we have a question. Jimmy asks, why does money supply equals inflation? Well, that's a good question, and the reason for the money supply and the growth in inflation is pretty simple to understand if you get the idea. So let me just pull off something. Let's see. So I think you can see it. Yeah. So let's say let's make this a bit thick. Let's say this is someone. This is a person. This is Jimmy. And this is let's see, and this is Timmy. Timmy over here is happy because he has a lot of money. Timmy has a lot of money. He is rich. But Jimmy over here is doing like okay. So let's say he has a little bit of money. But they want to buy an egg. So this is an egg. So since Jimmy has like $2 over here, Timmy has 4. Jimmy goes to market and sees the egg, and he says that I am willing to pay a single dollar because I can afford to pay you this much. But if I spend any more than that, I won't be able to get bread from this money. So and Timmy also sees that, and Timmy is like, well, I want this, and since he is willing to offer $1 and he is willing to sell it, I am going to also offer $1. And since there's a lot of egg, assuming there's like multiple eggs and there's no shortage in the supply of egg, they both get an egg for $1. But let's say Jimmy takes an egg with $1 and Timmy takes another egg for another dollar. So this is the first day. So on the second day, this would be like day 2. So this is like day 1, and this is day 1. The prices of egg is $1, and there's Jimmy takes 1 egg. This one's taken by Jimmy and this one's taken by Timmy. So there's 1 more egg left. So since there's 1 egg left, the next day Jimmy still has like $2 and Timmy has $1. Timmy has a lot of money because throughout the day Jimmy worked in his business, maybe got his paycheck or something, and still has $2. So the money they both have are the same. And Timmy goes to the market and offers to buy this one for $1. And since Timmy also wants to buy this egg, he goes like, only have one left, so I'm going to pay you $2. And the shopkeeper is obviously going to sell it to Timmy. But what happens if we increase the supply of money? Let's say I give Jimmy another $1, and Timmy, well, he has a lot but still gets another $1. So now they all have, okay, so now they all have, so Jimmy has $3, Timmy has a lot, let's say $5. Since we have increased the amount of money in Jimmy's account, Jimmy is going to say that, well, I'm going to offer you $2 because that's the most I can offer for this egg. But since Timmy also wants this egg, he says that, well, I really want this egg and I need it. I am going to pay you $3. And the shopkeeper is going to sell to Timmy. But in both scenarios, let's see what happens. Let's increase the zoom. Okay, so since Timmy has a lot of money, he offered to buy it for more. But since Jimmy has like a little bit of money, he only was able to send $2. But if the supply of money was not $2, so if the supply of money didn't increase by $1, Jimmy won't be able to offer this extra $1 because he won't have it to offer. And Timmy won't have to increase his offer by another $1, and he won't have to pay $3 for this egg. So what happened when we increased the supply of money? Jimmy got $1 extra, and he is willing to offer a better price or a higher price for this same product. The amount of egg, this is the single egg, the egg is still the same, but only thing we increased was the amount of money. And now Jimmy is willing to pay extra for this egg, and the price of the egg went from $2 to $3. So a 50% increase. 50% increase in price. And that is the inflation. But this is a straightforward example because we are having 3 eggs in the first place. In a bigger market, there's going to be a lot of eggs, and there's going to be a little bit less competition on the pricing because no one's going to offer like I'm going to offer, you're offering 1, I'm going to offer 2. Someone's going to say like I'm going to offer $1.01, but that single cent over there, that's the increase. And if Jimmy over here is like, well, I have the money to buy more eggs, well, I'm going to offer you $1.02, and Tim is I'm going to offer 3 cents, and that's how the pricing is going to increase because there's more money to spare, and the amount of liquid money in the hands of the citizens of the country as it expands for economic growth, the inflation is also going to keep up with the amount of increased money. So let's say the government printed around here like 15 trillion to the end of 2022 it went to like 21 trillion. So it's like almost 6 or 7 trillion dollars in liquid. No, not liquid, like semi-liquid. M2 is like the semi-liquid. Let's see if I can find the M1. Okay, so this is the liquid money. So there's like $4 trillion in liquid money in the hands of ordinary people and the citizens. But from here, when the Fed printed around 15 billion or 16 billion 16 trillion USDs, people got a lot of money in their hands, and there was a lot of money in circulation, and people were willing to pay an extra premium for the same amount of services and products, and which led to the economy to the growth. But as the people were offering a higher price for the same product and services without the significant growth in the quality of the product or the services, the inflation started to caught up, and at I think around 2022 the inflation like went through the moon. And as you can see, the Federal Reserve tried to tighten the monetary policies, and it started to take out liquid money from the markets, and we will also be able to see this in the M2 money supply. And around here the government tried to increase the tightening of the monetary policies and started to take out the liquid money supply from the market. And that's why the inflation and the money supply always correlates to one in another, and to keep a balance between the economic growth and the inflation of the day-to-day life and daily use products, the government has to find a delicate balance between the M2 and M1 money supply and the potential of the economic growth. If the government doesn't print enough money, there's not going to be enough economic growth, and it will make the regime look bad. And if the economy performs badly, there's going to be a lot of pressure on the government from the citizens and the political parties in the government. And that's why I would say this is a play of balance and delicate control, because you need both to have a spike in maybe growth for a little bit, and you need to tighten the policy by a little bit in the next phase of the economic growth, to keep the population happy and also maintain a sustainable upward trend in the economy. I hope that clears this out, and we will continue to do our research on this one.